about additional forms. We're going to be talking about the Schedule A, as well as we're going to be talking about the Form 1098. So let's make sure that we pay close attention when we look at that Schedule A so that we can really understand how did that Schedule A help us to get a little bit closer to zero. So just for those of you who are joining us for the first time, go back, take a look at Tax Talk episode 1 and Tax Talk episode 2, and you'll kind of be able to catch up with where we are today. So looking at that W-2, again, very important. We want to highlight the federal income tax withholding. That's the first thing we want to make sure we highlight. And today we're going to be looking at even further, looking at the state income tax holding and why is that so important with what we're going to be diving into. So when we look at an actual 1040 for that employee who's earned $96,000 in the year 2012, we actually see down here in the right corner, we actually see where that employee's total income was actually reported as 24,326. Now, how did we go from 96,537 that's reported on the W-2, as well as reported here on line number 7, all the way down to 24,326? Now, this was done through deductions as well as adjustments. And so we want to make sure we dive down into understanding what is those deductions, what is the adjusted gross income. As we see here, adjusted gross income represents that 24,326. So when we're talking about adjusted gross income, it's one of those acronyms, or we also call it AGI. But that basically means it's your total income, as I said earlier, minus those deductions or adjustments to income that you're eligible to take. So these are all legal deductions, legal adjustments that you're able to actually take to further reduce your W-2 taxable income. So let's go ahead and take a look just a little bit further. So we see here on this individual's actual 1040, we see that one of the main contributions, one of the main contributors in further reducing that AGI is itemized deductions. And so we know that there's a standard deduction and we know that there's an itemized deduction. And so we want to look into better understanding how was this individual able to have an itemized deduction of 19,320. So when we look at the individual's Schedule A, we know that the Schedule A is used exactly for that purpose. It's used for the purpose to figure or to report those itemized deductions. Now, in most cases, the federal income tax, your federal income tax, will be less. It will be lowered if you take the larger, whichever one is larger, your itemized deduction or either the standard deduction. In this case, the itemized deduction was more beneficial because it was larger for this individual tax return. So let's break down and let's understand the specifics of how did we get to this 19,320. So we see our first section here on line number 5A, we see that income tax. So we see 3578. Now, if you took a note when we looked at the state income tax, then this is the same number that's actually being reported here as an itemized deduction for the state income tax that has been paid. So that's actually here included in line 5A. And then we jump down to line 6, and we see here on line 6, it talks about real estate taxes. Now, quite naturally, when it comes to those real estate taxes are also able to be deducted. So here, where it says taxes that you paid, you actually see two categories. One for the state income tax of 3578, and then you see the second one for 248, which reflects those real estate taxes. Now, those two combined actually make up a grand total of 3826. So when we look at the deductions, we want to make sure, again, you don't leave anything out. You include all of your taxes, whether it's income tax, whether it's sales tax, or whether it's those property taxes. You want to make sure you don't leave anything out. So next, we also look at when it comes to paid property taxes. Most time you're paying property taxes on a home that you own, and so with that, you also want to make sure, as we see here in line number 10, that you also deduct the mortgage interest. And so the mortgage interest is highly important. And we want to make sure that you understand that that mortgage interest, it should be coming to you on a form 1098. This should be coming from your lender because they are required to report any amount that you as a borrower have that's $600 or more in interest, mortgage insurance premium, taxes, or either points during the tax year. So lenders are required to file a separate 1098 for each mortgage that you hold. So in this case, this individual has one mortgage, and we see here that the 3331 was captured on form 1098. Now, you also see an arrow that's pointing back to the real estate taxes, just to ensure that we make that connection and we get all of the information off of the 1098 that's applicable, that we can use as an eligible deduction. We want to make sure we capture it here. So as you see here in the second column, we have your total interest that was paid, and that's on line number 15, and that's a total of 3331. So each section adds up and it contributes to your overall itemized deductions. Now, let's go ahead and jump down to our next step, where we see gifts to charity, or we're talking about charitable contributions. And so here on line number 16, we can see that this individual made charitable contributions in the amount of 2665. Now, let us understand how this number 2665 was figured. So we jump down and we look at line number 18, where it shows this individual had a carryover from a prior year. So what I want to make sure everybody understand on this is highly important. When you look at your adjusted gross income, which we just talked about, you're able to gift up to charity. You're able to gift up to 50% of your adjusted gross income as a deduction. And so here, when we look at this individual's AGI, we saw that AGI was 24, roughly 24,000. Now, when we see here in line number 19, we see that AGI was actually taken all the way up to the max for the charitable contribution, which was 50%. And so 50% of that AGI is 12,163. And so when we look at how did we get that 12,163, we're looking at 78,098. That was actually a carryover from a previous year. And also we see here where there's a cap that's called disallowed contributions. So once you hit that 50% on the charitable contributions, then you have that amount that's actually disallowed. Now, you don't lose it. I want to make sure you all understand this. You don't lose that amount. That amount actually carries over to the following year. So this amount of 68.6 actually carried over for this individual to their 2013 charitable contributions. And so when you look at the disallowed amount, when you look at the carryover from 2011, and you look at the amount of 2665 for this year, then it brings a total on line number 19 of 12,163, which is equivalent to 50% of this individual's adjusted gross income. Very, very powerful. And so you want to make sure that all charitable contributions, you are actually keeping very good records, very thorough records. However you are paying that, whether it's being cash or whether it's with a check, my recommendation is that you pay in a method, whether it's direct deposit, ACH, or either you pay with the check so you can have documented records. It is acceptable to do cash. I wouldn't personally recommend cash. Sometimes things can get lost when you're dealing in cash. So make sure you have very good record keeping and you maximize on the charitable contributions. Very, very important here that you take advantage of that. So when we look at all the items on our Schedule A, we look at line number 9, we look at line number 15, and we also look at line number 19, and we see that all of those combined actually bring us to line number 29, which is a total of 19,320. Now, this is again the total amount of all itemized deductions. So I want to make sure you all really, really get this. I want to make sure you all really understand this before we even get to, next week's, where we'll talk about what were the additional deductions, what were some of those business or real estate, losses or deductions. I want to make sure that each individual know that when it comes to income tax, when it comes to property tax, when it comes to mortgage interest, these are all things you don't want to leave on the table, especially the deduction for charitable contribution. So these are things you can apply immediately, and you can get immediate results by applying these. So let's just keep it moving. We're going to go just back to the 1040, where now we're seeing on line number 38, again, that adjusted gross income. And then on line 40, you're seeing those itemized deductions. And so now you have a clear picture of how do you further reduce your adjusted gross income, which our target again is getting us all the way down to zero, which ultimately brings your tax liability and produces a full refund amount. And that's our objective. That's how we want to start, with the end in mind of getting to zero. So looking at 24,326 as our AGI, we also have here 19,320. And once you subtract those deductions, those itemized deductions, now you can see here on the screen, you're down to $5,006. And so you significantly reduced your adjusted gross income even lower than the 24, to where now it's at approximately 5,000. And so very, very important. Make sure if you have itemized deductions, you actually take those itemized deductions. You don't leave those on the table. Very, very important. Now, let's look at how those itemized deductions actually get us closer to our bottom line. So when we look at our payment, we know this individual, going back to the W-2, we know this individual had federal income tax withholding of $15,797. And again, we're starting to peel off all of the layers so that we can understand why this individual was able to why he was able to receive a full refund and reduce their tax liability all the way to zero, which is what you see here in terms of the payment on line number 62. So the payments that were withheld from his weekly, bi-weekly, or either his monthly payroll totaled up to be $15,797. And now we see that same amount that was withheld actually being refunded in full. And so again, very, very important. I know we went through that Schedule A um, rather quickly, but I want to make sure you all dive into the Schedule A, understand your individual Schedule A. Also, make sure you are receiving your 1098, your Form 1098, just so that you can ensure all of the interest that you actually paid toward any mortgage is captured and also it's reflected in your return, as well as those property taxes. Make sure you do yourself a favor. And so, again, just moving on further, you want to make sure all of your information when it comes to your refund, be it your routing number, be it your account number, your account type, whether it's checking or savings, you want to make sure all of that's right so that you can have your refund electronically deposited into your account without any delays once your tax filing has been processed and approved. So we went through that. We went through that Schedule A, and so now you all have an opportunity to go back, spend some time, do your homework with your Schedule A, with your Form 1098. And this is one of those sites, I keep pointing this out for you all. Very, very helpful in terms of being able to research those forms. This is where I actually go. So I use the official site of the IRS to go back and research all forms, be it the 1040, the Schedule A, other applicable schedules that we'll start to talk about, like the Schedule E, which we'll likely talk about in our next episode. So all forms, either for the current year or previous years, you can find all of those here, just to make sure that you're educating yourself, you're keeping yourself up to date with the latest information from the IRS. Now, we're going to go ahead and open up for any questions for those of you who have actually joined in. I really appreciate you all taking time out of your Saturday to be able to join us on YouTube, on Instagram, on Facebook. It's very much so appreciated. So we want to give you all an opportunity to share your questions, share your comments, or just anything you have regarding taxes that you need answered or you need further clarification on. Or it may be something we covered today, like the Form 1098 or either the Schedule A. So we want to give you all, an opportunity at this time. And while you all are getting those questions ready, there's a couple of things we're just going to talk about while those questions are coming. So make sure you continue to tune in to Tax Talk Live. We're going to be here every single Saturday, as I said, and we're going to be breaking it down line by line, form by form, to show you all how this individual who was actually making $96,000 a year was able to have a zero tax liability, and how you can take these same strategies, these same techniques, and legally apply it to your return. And specifically for those business owners, we're going to be getting into the specifics, the details of how you, as a business owner, are able to deduct a number of deductions, from business vehicles to business travel to home office, and so many other deductions that we're going to be covering, including tax credits as well. So make sure you all come back. You tune in every single week with us. 8 a.m. Eastern Standard Time, we'll be here. So this question, I see a question here that's on the screen from one of the viewers that's asking, when it comes to the Schedule A, is the Schedule A the only document that's going to capture those itemized deductions? And so just to make it very, very clear, the Schedule A is the official form to be able to capture those itemized deductions. And so the Schedule A will be the only form that you capture those itemized deductions. Now, itemized deductions are not the only deductions that there are to be captured. So there's other deductions that I don't want to get ahead of next week's episode, but there are other deductions that we're going to be covering. And also we're going to be talking about other schedules that you're going to be able to also understand and get an idea of what those schedules are for specifically, and the information that we record or we document within those specific schedules. But yes, for itemized deductions, absolutely Schedule A. Very good question. Thank you for that. So here's another question that I'm seeing here. What if I have a mortgage and I did not receive a Form 1098? This is something that should be happening every single year. So for the year 2023, you should have likely received your Form 1098 from your lender by January 31st at the latest. If you did not receive that and you have a mortgage and you know you've been paying your mortgage interest, then reach out to your lender, reach out to your loan officer, just to make sure that that mail maybe wasn't, returned back to the lender's office due to an incorrect address or something like that, or it wasn't just, forgotten altogether to be sent out. So make sure you reach out to them and you get your 1098, your Form 1098, so that you can capture that documentation on your tax return. You don't want to miss that. That's a huge deduction for your property taxes and your mortgage interest. So far, so good. These are really good questions, y'all. Just keep them coming. Okay, I see another question here that's talking about business tax returns. So it's a little bit complicated. I won't get too much into the details. So the question is, what forms or what schedules can be utilized to capture, those business deductions, as well as those business income and losses. So when it comes to your business, there's a number of forms depending on how your business is set up. You may receive a Form K if you have a partnership. And so that's one thing. Also, if you have a single member entity, for example, that usually will flow over to your 1040. And so there's a number of forms out there that's going to capture those business income, those business expenses, also those business deductions and credits. But make sure your tax preparation expert, your CPA, tax attorney, whomever, is capturing all of your business expenditures, your business income, as well as allocating them for the proper deductions. Okay. Any more questions out there? So far, those questions have been pretty good. Okay, I think we'll probably take these last two questions. And the first one is just relating to, am I able to apply the deduction for my mortgage interest and my property taxes on my 2023 return? So I'll just go back and touch on you want to make sure you have the form 1098. And so if that mortgage interest, if that, if those property taxes were actually paid in 2023, then they should be reported on the form 1098 that was issued by your lender. And absolutely, you're able to carry those. Now, I'll go a little bit further on the question. If that mortgage interest and those property taxes were not carried for a previous year, then you definitely want to sit down and you want to have a discussion with your tax preparation, your tax preparer or your CPA to make sure that they also capture that. Just because maybe you had mortgage interest and also you had property taxes in 2022, for example, and you didn't carry it. Maybe you forgot, maybe you received the form late, whatever happened, you didn't have an opportunity to carry it, then you're still eligible to get those deductions. Don't leave that on the table at all, please. You're leaving money on the table if you assume that you're not able to carry it. That's why I say, talk to your tax preparation expert, allow them to explain it to you. But I'm telling you, you're legally able to carry that. And then just the final question is talking about prior years. How many years are you able to go back to do amendments? It's typically 3 years to go back and be able to do amendments. And so it all depends on when you actually file that return, or actually when you filed an extension for that return. And so there's a number of things, but generally it's around 3 years that you're able to go back and you're able to make amendments. And so if there's something that you left out by mistake, you just forgot it, you received documentation late, even if you change tax preparation experts, then by all means, make sure your new tax preparation person is going back to do a thorough check, to thorough review your previous tax returns to make sure everything was filed and completed accordingly, that you were eligible for, and that your return was filed legally. And so that once they do that, then it sets you up to be able to have a very bright future in terms of your taxes going forward. Now, if there was something that was missed, whether it was unintentional or it was just missed from not knowing, for whatever reason it was missed, then your new tax preparation expert is able to go back and make that correction. Now, I'm sure it may be, some additional forms to be filed with that. However, they are eligible to go back and file that amendment so that you can get those deductions or credits or whatever adjustments that you're seeking to ensure that you maximize your tax benefit. So those are the questions we're accepting for today. I want to encourage you all to continue to reach out, continue to provide questions, whether that's on Facebook, whether that's on Instagram. Continue to send us those questions and continue to join us every single Saturday here on Tax Talk. We want to help you. Also, just like this individual, we want to help you lower your tax liability all the way to zero. And as we know, in this case, this individual is making $96,000. So this show is dedicated for those of you who all are making less than $250,000 a year. And so you want to make sure you take advantage of these powerful yet legal strategies that have already been implemented. And that's why we're using previous returns. We're showing you what's already been implemented so that you'll be able to, very clearly see, and you'll also be able to very clearly take these, implement them right away, and get your own results. So thank you all for tuning in. This concludes this week's episode number 3 of Tax Talk Live on YouTube, Instagram, and Facebook. And we hope to see you back here again, same time, same place, next Saturday, 8 a.m. Eastern Standard Time. So you all enjoy the rest of your Saturday. We'll see you in the next one.